School of Economics, School of Economics 5th Annual Economic Conference. I would now like to call upon Dr. Sharad Maheskar, Pro Vice Chancellor NMIMS, who has always been a guiding light for our school to deliver the welcome address.
Thank you. Good evening and good morning to our friends from US. Professor Viral Acharya, Professor of Economics, Stern School of Business, New York. Professor Amita Vaidya, Director, School of Economics, NMIMS. Delegates for the conference and participants to this event, faculty and students. It gives me immense pleasure to be present for the valedictory session of the 5th annual conference organized by the School of Economics, NMIMS, in collaboration with the Indian Econometric Society. Every year, we at NMIMS have seen the conference being organized with a great zeal and enthusiasm. The conference is blessed every year with eminent economics and researchers. So is the conference blessed this year. I have been witnessing the success of this conference every year. This year, the theme of the conference was the crisis and challenges and the way ahead as we go through this crisis. Indeed, an important and relevant theme, considering that we are just coming out of the pandemic and deep inside the second crisis in the form of the Russian-Ukraine war. Solutions to such crises are very important to the survival of the mankind for peace and prosperity and growth. In the inaugural session, we had Professor Fontana from the University of Leeds talking about the effectivity of the measures taken by the EU to tide over the COVID crisis and the sustainability and serviceability of the Italian government debt, a topic of such importance to all countries in the world. I am sure that the parallel sessions which you have been witnessing before this valedictory function were conducted with a lot of energy and insights, and the sessions would have been engrossing and thought-provoking. There would not be a better culmination of the conference than the conference speech that we're going to witness and hear from Professor Viral Acharya on India's digital leapfrog for the financial inclusion. With the background of Professor Acharya as a professor of economics in the Department of Finance at the NY Stern School of Business and his earlier stint at the RBI as a deputy governor, besides his exposure at SEBI as a board member, would give us a lot of insights into the digital landscape of the Indian banking sector. I thank Professor Acharya for accepting our invitation for delivering the conference speech. Let us all hear his thoughts on an important theme, which is so relevant today. Thank you.
Thank you so much, Professor Maheskar, Professor Vaidya, and all the guests and participants. I know it's an academic conference. My talk is not going to be terribly academic, but hopefully maybe it stirs some thoughts on the kind of research we might want to do going forward. Let me just try and share my screen if possible. Can you see it well?
Yes, it is.
Yeah, okay. So I wanted to talk about some things that I think are probably moving in the right direction in India as a whole, which is the way our digital plumbing is progressing. And as we just heard, of course, there are all sorts of difficult challenges raised by the pandemic and the war. But one theme of the recent years is that there's difficulty in doing cash-based transactions. There's difficulty in remaining entirely in the informal economy, both in terms of reliance on cash, but also in terms of opacity or lack of transparency to finance providers. And the big question is, can we open up India's informal economy and bank with them? And I'm using the word bank, but what I really have in mind is provide them financial services in a way that one can really claim to have financial inclusion. India is moving very differently in this space compared to most of the developed economies and at the other end in China. And it's interesting to see how and why that's happened. This talk is based on some inputs from Tanuj Bhojwani, Kamya Chandra, and Sharad Sharma of iSpert team. Many of you might be aware what iSpert is. It is the industry software products roundtable for India. They basically set standards for software development in India. It's a think tank of sorts. And they've been largely responsible for this digital plumbing that India has put together. So what's the challenge? The challenge is that in 2008, less than 15 years back, only 17% of Indian population had bank accounts and only 15% was using digital payments. Even though we nationalized banks in 60s and 70s under the guise of financial inclusion, actually, it's not at all clear that we achieved much financial inclusion for at least 40 years since then. What really happened was actually thereafter, between 2008 to 2021, there's sort of been a form of a digital revolution, maybe a small one to start with, but once all the pieces were in place, it sort of started accelerating, and the pandemic gave a lot of fillip to its overall adoption. Now there are 700 million unique mobile connections, 1.2 billion plus digital ID Aadhaar enrollments, over 600 million internet users, several billion digital payment transactions are taking place on a monthly basis. And importantly, both at individual and business level, there is some shift towards digitization. I would say right now this shift is stronger at the individual level. And what this talk is about is how can we complete the shift towards digitization and formalization for the micro, small, and medium-sized enterprises. But clearly, many of us think that the ingredients are all in place. Now, as I said, this acceleration in India has happened in a slightly different way than in the West and in China. Take United States, for example, where also actually financial inclusion at the lowest end of the pyramid is not that great in terms of people having bank accounts, being able to use digital finance. And part of the problem in United States is that it has a fairly primitive payment system. In fact, I can't tell you how bad the payment system in United States is. There's no standardization. Every bank has its own payment system. If I try to do a wire transfer, even within United States, sometimes there is a back office of the bank that's actually verifying everything, and I can't get the wire transfer done without my personal involvement at the bank branch, sometimes even for 24 hours. I just sent some money to my parents in India, and I had to literally call them up first thing the next day morning saying, listen, guys, I had to send the money by 12 p.m. and you haven't even wire transferred it to the correspondent bank. And that's because the payment system in US is very fragmented. They've adopted a model that they will allow each bank to have its own payment system, rather than actually thinking of payment system as a utility or a public good. In China, in contrast, rather than there being a proliferation of payment mechanisms, they allowed one or two large digital players such as Ant Financial to sort of become the dominant private force. And of course, as you know, that became a concern for the Chinese government that they are becoming too powerful, concentrated, and there is a general crackdown on the tech sector's concentration in China. And in a way, you can see that both these models have some problems. If you leave it to individual banks, they don't want an interoperable payment system because they don't want to lose their customers. They want to attract all the order flow on their payment system. So they don't have a reason to actually make all this interoperable. If you allow just one player, but who's private, then you run into this usual problem that either the government could then abuse the private player, or they might fear that the private player has very high concentration. India, in contrast, has gone down the path of saying that the payment system is a public utility. Through the creation of a public digital infrastructure, what is called as India Stack, a set of software protocols developed by the iceberg team and some others. And the analogy is that to solve the market problem of transportation, you create physical infrastructure such as roads, railways, airports, streetlights, and these are typically provided as public utilities because they have a huge externality or spillovers onto everyone. So no one individual entity, a private entity, will have an interest in developing them. But once the municipality or the state or the nation provides these, then private cars, taxis, planes, trains can flourish, building on top of them, connecting people from one geography to the other. We can think of digital infrastructure as a similar problem, which is that different accounts need to be connected in order to make payments. And as I said, if you leave it to individual banks, there is a problem that they don't want to make it easy to connect a JP Morgan account to a Bank of America account or an HDFC account to an ICICI Bank account. But suppose you automatically connect them through digital pipelines, which is actually a public utility, the plumbing of the digital infrastructure system. So suppose the connectors between bank accounts is not something that HDFC and ICICI have to create, but it's actually a part of the payments utility of the system. It can be an open technology. It can be subject to sort of the right encryption and quality and time of connection standards. It can verify identity. So in order to make the transactions fraud-proof and secure. And this way, then private banks, non-bank finance companies, others can build on top of these digital pipes and focus on provision of services rather than focus on monopolizing access of the customer so that they can then gouge or milk the customer through various kinds of payment fees and so on. Now, what made this possible was that iSpirit and India Stack have been developed. iSpirit has developed the India Stack in what I would call as a very modular layer. First, they focus on the identity or the Aadhaar layer, giving every resident a unique ID and enabling them to prove I am who I claim to be using digital authentication, two-factor authentication, as we know happens in India with these one-time passwords and so on. And you know, several tens of millions of such verifications are taking place in India on a daily basis digitally in order to authenticate individuals who are participating in digital transactions or businesses. Then second module was the payments layer, which is to connect these payments, create this public utility payments infrastructure, which of course has to build on top of the identity verification. It's interoperable, fast and cheap in India. As I said, it's far superior to what I experienced in the United States in terms of the speed of execution. And then the third layer, which is currently under development, is the data empowerment. If now everyone is digital, if everyone is connected through these pipes, data can now be transferred in a secure manner so that financial services using this data, using the data to assess credit scores, using the data to assess who should get how much credit, can be now unleash banking and financial services for $1 billion plus. I really think about this as sort of like pieces of a chess puzzle, a chess game. Like once we figure out how to move the pawn, then we figure out how to move the bishop, the rook, the knight, the queen, the king. But of course, the beauty of it all is when you can combine them into combinations or what are called as more complex strategies in chess. And then, the sky is the limit as far as how deep you can go in designing a complex chess game. I think it's the same now that these individual modules are in place, private entities can develop on top of this. Many of you are aware of these things. The key developments in identity layer were Aadhaar, eKYC, and eSign. In the payments layer, UPI was clearly the I would say, the most important breakthrough. And in data layer, as I'll explain, we have something called as DigiLocker, where you can put your electronic documents, account statements as a document repository. But then you have to provide a consent, which is, oh, I want to share my documents with a financial service provider. And of course, all of our documents are broken up in different places. There are some with mutual funds, some with insurance companies, some with banks. So ideally, rather than getting the individual statements and then putting them into a locker, why can't we just have an account aggregator, like a super custodian of our data that can seamlessly take consent from us and then transfer the data with encryption and privacy protected to a potential provider of financial services. So the phase one, as I said, was really about opening of new accounts, verifying identity, ease of digital payments between person to person, person to merchant, government to person, business to business, etc. All this is done through this beautiful system of the UPI, where someone is making a payment to a payer, is making a payment to payee. And all that needs to happen is that I need to reveal my identity, I need to reveal the payee's identity, the two get authenticated. And then in the backstage, there are these banks, the remitter bank and the beneficiary bank, who will be operating through the UPI, again, doing all the authentications along the way. And everything is two-factor validated because you have a unique Aadhaar or a mobile number that's attached to the payer and the payee. It could be a PAN in some cases. So that was phase one, and we are all aware of it. But the phase two, where we currently are, is now this expanding access to financial services, credit, insurance, investment. And for this, we need to be able to share data, and we need to be able to scale up partnerships, which is how can a borrower not get locked on to a bank? How can an insuree not get, the insured not get locked up with the insurance company? What if they are being gouged in terms of the interest rate or the insurance premium that's being charged to them? Can they seamlessly now move their transaction records and history over through an interoperable system to another provider so that they can, through this competition, attract the best rates or the best premium? Conversely, can a new player in the financial sector use the digital plumbing or the connectors in a seamless, easy manner to have quick entry as a fintech player in this space? Because that is what will create competition and prevent the big banks or the big insurance companies from gouging or not necessarily expanding access down the pyramid as much as India needs, because they are very happy making thick margins of those who are already in the digital network. So why is this issue now, why is this phase two important? It's important because even while India is getting digitized and making digital payments, credit, which is really the lifeblood for small, medium-sized enterprises who don't have physical collateral, who don't have as much liquid cash flows, who need a lot of working capital to function. A lot of India's MSMEs are service providers, for example. They very often are not in the credit network. Only 16% of our MSMEs are in the formal credit system. Rest are in the informal systems. And why India does have a thriving informal system, it doesn't allow scalability. It doesn't allow investments in capital as much as these MSMEs need in order to get out of the trap of remaining small throughout their lives. So it's a huge gap that needs to be filled in. Some estimate this credit gap in India to be on the order of $3.5 trillion. And so any dent that can be made, as much of this iceberg that can be brought out of the ocean and provided credit to would be good. Now, the iceberg analogy is good because you actually don't know how deep it is until you actually figure it out. And that's because most of it is hidden, it's opaque, it's in these dark corners of the informal economy. So in some sense, what a few of us in this area think is that what India needs is embedded finance. Historically, we have thought about providing finance to these end borrowers, such as micro, small, and medium enterprises, by saying, oh, banks should hire loan agents, banks should hire collection agents, and then try to deal with this MSMEs. But the loan agents or the collecting agencies, they are not in the ecosystem of the micro, small, medium-sized enterprises. The Reserve Bank of India has tried a few different models like correspondent banking models, etc., to get over this hurdle. However, what you would ideally like is that can an agent who's in the ecosystem of the MSME act as an intermediary for this ultimate credit or financial service providers such as insurance companies, because they are the ones who receive savings. Banks receive cheap deposits, insurance companies receive savings in the form of insurance premia or investment accounts. Can they be connected to entities that are embedded in the ecosystem of the MSMEs in order to have better screening as to who should you provide a loan to, better verification, better sourcing of potential clients, and then ultimate encapsulation of cash flows rather than sending goons to collect the cash flows, as very often done with small loans in semi-urban and rural areas. Can it be done through digital platforms? Can it be done through digital intermediaries? And that's sort of what we are thinking of in embedded finance. What it needs is a structured high-trust data ecosystem. So MSMEs and the financial service providers should be able to move data back and forth. You have to then be able to use this data or information as collateral to do credit scoring and figure out how much to lend or how much insurance to provide. And we need an agent of the borrower who's embedded in the borrower's ecosystem to be used as a provider of these services. The broad idea is that we have to move away from physical collateral to information collateral because many small businesses don't have physical collateral. If they are services company, their main collateral is the fact that they have a service flow. They have a payments flow that happens on back of that service flow. So you have to be able to observe that. You have to be able to encapsulate that history and then use it to assess what kind of credit, at what maturity, at what scale should be provided to that MSME. You have to be able to use some digital techniques as is done in credit scoring models, use algorithms, use historical data on defaults and recoveries to figure out, given a certain kind of payments pattern, on average, how many borrowers with that payment pattern default, and then the banks or the insurance companies can then provide suitable products based on that. And finally, we have to be able to move away from these third-party agents to providing loans where these MSMEs are operating. So if MSMEs are operating on a sharing platform such as Flipkart or Amazon or Big Bazaar, can you directly layer the financial services onto that sharing platform? Because the MSME has a reputation to hold on that platform, and the platform is only keeping those MSMEs which are actually delivering high quality services, or at a minimum, they would have ratings for the MSMEs based on their selling and making of payments. So, to create a high trust data ecosystem, India Stack has now created what is called as an account aggregator framework. What is an account aggregator? Every time we trade or deal in a financial transaction, we are actually leaving a digital footprint somewhere in the financial ecosystem. If you do a bank account, there is a financial transaction that's recorded with your bank. If you do an insurance premium payment, you are leaving a digital footprint there. You make a utilities payment, you are actually leaving a digital footprint over there. You invest in an SIP or take out some money from your SIP, you are again leaving a digital footprint there. So there are digital footprints of transactions being created all the time by individuals and the MSMEs. each entity over here is a custodian of your data. They are technically not supposed to be allowing this data for use by others without your consent, because that would be a violation of privacy. It could open up scope for fraud and so on. So an account aggregator can be thought of as a super custodian digital service. It can be one of these entities itself, or it can be a new private institution that operates using the digital pipes that are publicly provided, that are known to be state-of-the-art, secure, encrypted, so that data authenticity and integrity won't be compromised, and that respects the legal framework of the personal data protection as per the country's laws. So, say I, as a digital user in the Indian digital system, give consent to share my data to the account aggregator, which is now a consent manager for me. The account aggregator then requests the data through digital pipes and using standard data APIs from a bank, a mutual fund house, insurance provider, a tax GST platform such as the e-GST platform or the e-marketplace of the government. And then the data flows again through the authenticated digital pipes, end-to-end encrypted by the public utility to financial information users. These could be providing a flow-based credit based on transactions flow that they see. It could be a personal financial advisor. It could be an insurance company. It could be a wealth management provider, and so on. Now, what this means is that the account aggregator, once someone has entered the financial system, the account aggregator is useful. But you could also view the problem as reverse, which is this financial information users would like an easy way of figuring out who are these potential users in the first place. So how do you do that? You need to figure out who are these creditworthy borrowers and discover them. Okay. The banks or the financial service providers would also want that if they make a provision of credit or insurance, the payments that are to come should get encapsulated on that digital pipe itself. I don't want to hire third-party goons or collection agencies to make this collection because it's very inefficient. That is what actually detracts many people from entering the formal system if the collections are going to be draconian rather than seamless through the digital system. Now, what iSprit has created for this is an open credit enablement network. What is an open credit enablement network? In this system, the sharing economy platforms can be thought of as loan service providers or financial service providers for the ultimate financial information users such as banks or credit card companies or insurance companies. Why the sharing economy platforms like Kirana Tech or gig economy aggregators or social networks or agri-tech or e-commerce platforms? Because they have a pre-existing relationship with MSMEs. It could be a restaurant or a delivery service. They already have unique data on the transactions that are being done on that platform. These transaction data, with the consent of the potential borrower, being the MSME in this case, can be provided to the end financial user. The MSME is already doing financial transactions on that platform, and so the ultimate transaction flow of payments and repayments can also be encapsulated on the platform in order to make the timely payments or repayments. And because they have a reputation to hold, they would have a very high cost of defaulting on platforms done through this gig economy or the sharing platforms. But to do this, again, you need an open system because you need competition, you need access, and you need as many players to come in and have access to the digital footprints that are being created in the sharing economy or the gig platform. So for this, basically, some bridges have been created in this open credit enablement network. What do these bridges do? They connect the lenders to the MSMEs, but via the borrower-facing marketplaces who can act as loan service providers. What are these borrower-facing marketplaces? As I said, this could be the GST platform, this could be the e-marketplace of the government to where it does financing for securing of products for different ministries. It could be Flipkart, Big Bazaar, Amazon, etc., etc. But the important point is that each of these lenders is not trying to set up its own mechanism to get into the digital network the way it happens in the United States. It's going to happen through a common bridge, which is this open credit enablement network. And because it's standardized, anyone can enter on top of these APIs tomorrow. Okay, just the way a new bank can connect digitally to any payer through the UPI very easily. The same way, now you want to take this combination of pieces of digital modules to a more complex level through provision of credit and other financial services. So here's a simple example. Think of a loan service provider here, which is the government e-marketplace or the GEM. Okay, there are micro and small enterprises providing goods and services here. So they have an invoice, say, against a ministry, and that invoice is now a potential cash flow in future. The invoice is a digital record of that potential cash flow coming in future. And the micro enterprise is trying to liquefy that future promise of repayment by the ministry. They want to essentially get account receivables financing. So the MSME can get onto the SAHAY GEM. The SAHAY is the app for them to do the account receivables financing. They have a GST username. They enter the GST authentication. There is a two-factor OTP that they have to submit. They submit it and the account is created. They are linked now to the government e-marketplace. And now you can see the orders that are in place against which they can potentially raise account receivable financing. So they have an ONGC repayment coming due of 150,000 rupees, a Ministry of Electronics and IT repayment due coming in, at certain point of time of 32,000 rupees. So these are the eligible account receivables, and they can now borrow against this. The maturity will be tied to the arrival of this payment, which is due at the respective dates. And they can borrow against it for a certain maturity, repaid. Some grace period is provided because the payment from the government may have some delay as well. And because this information is available, immediately the information with the consent of the user can be relayed to the potential account receivable financing providers such as these banks. And the banks look at these records, submit it to their internal loan origination engines, and banks are digitally showing up these offers for this MSME. You can see there are different interest rates on these loans. The borrower can pick the best offer that's available, do an e-sign sign the facility on the app itself, once again through the e-sign delivered through this digital platform. And it's all subject to the same standards of these APIs developed by India Stack. It's all happening in a very secure and encrypted manner. You once again do a two-factor authentication, and the loan is made. And the beauty of it is that the repayment is also created. The repayment is now encapsulated over here because you know that the loan is against a particular cash flow that the government ministry is going to pay this MSME. So when the cash flow comes, it will automatically get directed as a repayment to the bank. And the loan gets dispersed. This can happen in a matter of seconds or at best minutes. Okay, so this is the way that Account Aggregator and OCEN can sort of accelerate MSME credit by providing high trust data transfers between loan providers and the ultimate borrowers. So to just put it all in perspective, there's a lot of digital India platforms which are getting created right now. On the very outside, you have the ultimate utilities such as Aadhaar, e-sign, UPI, account aggregator, now OCEN, the ability to do Aadhaar eKYC, the ability to do e-sign of loan documents, etc. Account aggregators. What's missing is a public credit registry so that the same borrower is not actually using a particular cash flow or the same collateral to borrow against different, to borrow from different borrowers. It's something that the Reserve Bank of India will have to put in place at some point. But with this outside stack of utilities, now you can have the middle layer of more complex services. You can do customer sourcing, customer KYC, loan application, loan underwriting, loan acceptance, loan disbursement, each connecting with the corresponding digital pipe that's out there. And so the ultimate vision for the digital leapfrog for financial inclusion, the expansion of credit at the extensive margin for those who are currently in the informal economy, is that right now this segment is very fragmented. There's lots of bilateral connections in the informal economy, and it's hard for the formal players who receive the big chunk of savings, such as banks, insurance companies, mutual funds, to reach out. So what you can do is you can structure this sort of network in the following way, where essentially you have, say, for example, banks receiving the lowest cost of capital in terms of their deposit funding, reaching out to the intermediate loan service providers or fintechs who are embedded in the ecosystem of the MSMEs. This could be individuals, businesses at different scales, but now you can get a more organized digital credit system in this manner. Just one final word, which is that this is a way to expand credit by allowing those who don't yet have credit into the formal credit system. Banks and the intermediate players still have to manage risks. They have to know their clients. They have to know their credit scores. These credit scores have to be reliable. So there can still be boom and bust cycles here. Ultimately, regulators and these entities will have to do the right levels of risk management to manage lending cycles. I don't think digital per se is a way to necessarily make things secure. Of course, data will be secure. Repayments will now be more efficient, but there can still be lending excesses if the credit scoring models are not right over here. So that's a job for the bank risk managers. That's a job for supervisors. That's a job for the overall banking regulator. Let me stop here and take some questions if there's time.
Yes, sir. So thank you so much for that very insightful session. We'll now have a brief question answer session that will be moderated by Dr. Anand. If there are any questions, they can be put on the chat box or sent to Anand sir via the chat box.
Seems there are no questions. It was a very successful lecture. So.
I think they might be right. They might be right.
Yeah. So I think since we didn't announce it earlier, people may be putting it on the chat box. So just a minute.
Just wait for 1 minute. Yeah, I think we have our first question here. The question is, in light of the current government's call to privatize PSBs, do you believe this could change the trajectory of digital inclusion, especially down to rural India?
Yeah, I think it's certainly possible. I think one area where perhaps public sector banks have lagged is the adoption of latest technology that's available. And public sector banks, the good news is that they carry a lot of trust, especially in times of stress with the end consumer. The downside is that even the basic consumer who trusts the public banking system is sometimes tired of not getting quality service at the branches and so on. Now, is it that they are not able to invest in technology because they are not well capitalized, so they don't have resources, or whether because they are not able to hire the best talent in the markets because they can't pay certain kinds of salaries? I don't think anyone has been able to figure that out yet. But privatization could help on both fronts. It could allow public sector banks, once privatized, to be able to get capital in a timely manner. They might be able to change the internal compensation and incentive mechanisms. And indeed, digital transformation could be one way that they could move forward. Of course, some public sector banks are doing a better job on technology than others. So I don't want to sort of, brand all public sector banks in just one umbrella on this front. But I think this could be one of the collateral benefits of privatization, in my view. I think, my sense is we are always short of our disinvestment target. So I think, yes, the intention is there, but I don't know. I think we have to wait and see when it actually happens, because things just keep getting postponed because we are always behind, and then some shock comes and hits, and equity valuations are then no longer attractive. So I think we have to wait and see. But I think improvement in personnel, improvement in compensation practices, productivity gains through technology adoption, I think this could be some of the big collateral benefits of privatization.
We have a question from Dr. Meskar. Is our digital transformation also backed up by a secure cyber framework? Very important in view if the poor digital cyber literacy in India, even in educated cross-section of the population.
You mean in the sense of cyber security, or?
Yes.
Yeah.
In view of.
Yeah, I would say, if anything, the problem might be the reverse in India, which is that my sense of the average Indian psyche is that they are very averse to a fraud. They are very averse to, someone getting their information and abusing it. And so a lot of people, even who are reasonably literate to be in the digital system, are sometimes averse and not wanting to engage in credit card transactions or digital payments because they are sometimes not sure about whether their data is going to be secure in the end or not. It turns out that in India, the digital payment system, Aadhaar verifications, etc., at least those digital connectors are very secure and encrypted. And there needs to be more awareness provided on this, that no, don't worry about doing a digital payment. It's actually very secure. And, an occasional aberration might occur through a company or a fintech, abusing your data. But I think that's no more uncommon in India, perhaps, than it is in the rest of the world. Perhaps accountability and penalties might be more stringent and more timely in the developed economies for data-related frauds. But I would broadly agree that maybe what we need to do is to make more people aware of how India's digital finance is operating through a set of public pipes subject to certain standards, encryption, integrity, privacy protection, so that individuals and businesses become more comfortable about coming on board rather than viewing digital as being too efficient and therefore a potential leakage mechanism on their private data. So, what I'm trying to say is that sometimes we need to break the barriers that the Indian psyche has in moving from informal to the formal system, because they somehow think that my data now could get lost in cyberspace and be abused by someone. But actually, India's payment system is extremely secure, given that it's developed through a utility approach rather than a private payment systems approach.
We'll go for one last question. How do you look at the effect on the operating procedure of monetary policy in light of the prospectus of introducing the digital currency into the banking system by the government of India?
It's a very complex question. I don't have a full answer to it because one, it's not been done before, so a lot of it is speculative at some level. In a country like India, there is a concern that that savers being able to switch into a central bank digital account could hasten the pace at which confidence on a bank is lost. That when depositors are running on a bank, if they can simply run on a bank and move it into a central bank account, which will clearly has the backing of the sovereign, that these runs can now happen at a much faster pace digitally than they can happen through withdrawal of cash or something like that. There's also a concern that, especially with there being lack of clarity right now on crypto and so on, that first you could pull out on a bank and then use perhaps your CBDC to do some crypto accounts. And this could also become a way through which there could be a run on the currency, for example, which is that, you could not just be running on a bank, but you could also be running on the rupee at the same time. So emerging market central banks have concerns of this type, which is that they are often trying to build walls through capital controls to ensure that rupees don't leave the country at a very fast pace, so that they have time to actually prevent a disorderly depreciation of the currency. And that opening up digital pipes for currency transactions, which are not regulated, can actually hasten the pace and then make it practically impossible for the central bank to intervene in a timely manner. As you might have seen, the Reserve Bank of India has been in favor of regulating crypto assets. In fact, they have said they would prefer a ban. And simultaneously, they are keen to launch some form of pilot for the central bank digital currency. But my conjecture is that they would hesitate to do so until they have clear guidelines on how crypto assets and digital assets are going to be regulated by the government in some form. I think it'll happen as a small pilot rather than something that happens on a big scale very right away. So there is a third view, which is that why does India need all this? Because India has an excellent payments mechanism. So some people see the virtue of crypto as facilitating payments. That banking systems are very complicated in the West because of fragmentation of payment system. So I use Venmo, for example, to make my payments with people with whom I play tennis, because I'm with a different bank, they are with a different bank, and our payment systems don't sometimes talk to each other. But they are connected through this Venmo, which is like a digital payment service. But we don't need this in India. I have no problem making a payment from my HDFC bank to anyone else who's with any other bank, because I just know their UPI account, and that's all I need to know. I don't need to know there is a common payment system that's connecting them. So my sense is that the surge of crypto in India is more as a speculative asset class, and perhaps in all likelihood for some tax evasion purposes, etc., because it's not clear exactly how gains or losses on this asset class will be treated as of now. I think if I was a central banker, I would support the measures that RBI is taking, which is to consider having a digital currency so that those who want safety have an alternative mechanism. But think hard about why is there a craze for crypto, and could it be attached with some adverse consequences when we need to put a wall around the country through capital controls if currency is depreciating very quickly, etc. I don't know if that's a very focused answer, but as I said, it's all very speculative. China and a couple of other countries are the only ones that have some pilot going on in the form of a central bank digital currency, and we are still learning as to how all this will play out. I think the United States has also now issued a report of its own through the Board of Governors. So people are still studying it. There was a panel that I moderated between our former governor of RBI, Dr. Subba Rao, and Professor Darrell Duffy of Stanford. It's on YouTube. It's part of the NYU Stern India initiative. But you can, I think it's probably called a panel on cryptocurrencies and CBDC. I think CBDC was the main theme. And if students are interested, I highly recommend you to look at it. I think they are both experts on this, and they offer very balanced considerations of the gain, of the various trade-offs, both for developed economies and for emerging markets from going down the path of CBDC.
Thank you, Dr. Acharya. Back to Leah.
Thank you, sir. Thank you, Dr. Acharya, for a session that definitely highlights a future path for India that we hope to see implemented one day. I would now like to call upon Professor Amita Vaidya, Director, Sarla Anand Modi School of Economics, to announce the much-awaited Best Paper Awards and deliver the vote of thanks.
Thank you,
Thank you so much, everyone. Thank you.
Oh.
Thank you, Professor
All the
Acharya.
best,
Thank
and
you.
congrats
Thank you.
to the best paper winners. Yeah.
Thank you so
Thank
much,
you,
Dr.
sir.
Acharya.
Yeah, thank
Sure,
you.
my pleasure. Bye.
Thank you, sir.
Good evening, everyone. It gives me great pleasure to announce the Best Paper Award for the 5th Annual Economics Conference. The Best Paper Award, which is accompanied by rupees 10,000, goes to Sugandha Harya from Indian Institute of Foreign Trade for her paper titled Labor, Trade and Wage Inequality, Some New Results. Congratulations, Sugandha. Can we have her video on, please?
Can make her post.
Okay, then it's fine. Otherwise, it's fine.
Right.
So it gives me great privilege to express my warm and sincere thanks on behalf of Sarla Anand Modi School of Economics to Dr. Acharya for his conference talk. He gave us a great insight on how the use of disruptive technology, OCEN, and account aggregation can help in financial inclusion. We thank him for the wonderful talk, and I'm sure each one of us have greatly benefited from it. I would like to express my thanks to Dr. Maheskar for his welcome address and his willingness to always accommodate us. Thank you, Dr. Maheskar. We are also grateful to the Indian Econometrics Society for collaborating with us to bring you this 5th Annual Economics Conference, and we look forward to more such collaboration in the future. I would also like to thank Ms. Meena Saxena, the Director of International Linkages, and her entire team for her support for the conference. I would like to sincerely thank Dr. Santosh Kumar Sahu and Dr. Rahul Sapkal for chairing the technical sessions. We are especially pleased to have researchers from all across India who have sent their papers, and I thank all of you who are present here and those whose papers we were unable to accommodate. The success of this conference depends upon many people behind the scene. And I would like to thank the co-conveners of this conference, Dr. Anand and Dr. Imran, for the work and effort that they have put in. I would also like to thank the entire administrative staff for the support they have provided. And last but not the least, I thank all of you present here. Thank you so much.
Thank you.
I think we can see Sugandha also. Thank you, Sugandha, and congratulations to you, Sugandha. Once.
Thank you very much.
Yeah, congratulations.
Thank you very much. I'm sorry, I think my net got disconnected in between, so I couldn't listen to anything. Thank you very much.
Okay. I have a request to all the participants. We will be sending you a feedback form. So please kindly fill it. It'll just help us to make our conferences better for the next year. Thank you.
Thank you all and good night.